Hi everyone, my name is Manvi Walia. Welcome back to my channel. I hope you found day one of our investment series insightful. We are diving deeper into the world of stock today. By the end of this video, you will surely have a clear understanding of the types of stock, how to analyze them using financial ratios, and essential tips for first time investors. So let's get started. To begin our stock journey, let's first understand the different categories of stock. Knowing this is like setting the foundation before you build your investment portfolio. First one is large cap stock. Companies with large market capitalization, often well established and stable. For instance, think of companies like Reliance, Tata, or Infosys, giant in this industry with a history of consistent performance, risk, and reward. These stocks are considered less risky, but they usually offer moderate return compared to small companies. In short, investing in large cap stock is often described as safe as house, a dependable choice for those seeking stability over high return. Now let's discuss about second one, mid cap stock. Definition: companies with medium market capitalization growing but not as large cap stock. For example, Voltas or Godrej Properties are mid cap companies that are expanding rapidly but have not reached the scale of large cap firms. Risk and reward: these stocks offer a balance, moderate risk, and the potential or high growth than large cap. Investing in mid cap stock is like being in the middle of the road, balancing both risk and reward. Now, let's discuss with the last one, small cap stock. Definition: small companies with high growth potential but also higher risk. For example, think of emerging startups or niche player like Zomato in its early days. These companies might not yet be industry leaders, but they have room to grow. Risk and rewards: high risk, high reward. Those stocks can experience significant price swings. Investing in small cap stock is like finding a diamond in the rough. They can be hidden gems with immense potential. Now that we have classified the stocks, you might wonder how to decide which ones suit your investment goals. This brings us to our next section, analyzing stock using financial ratios. Understanding financial ratio can feel intimidating at first, but trust me, it's simple than it seems once you know the key ones to focus on. Now discuss first one, price to earning ratio. It tells you how much you paying for each rupee of earning. For instance, if a company A has a price earning ratio of 15 and company B has a price earning ratio of 10, company B might be undervalued, making it a better buy. Risk and reward. A lower price earning ratio can indicate a good buying opportunity, but always compare within the same industry. This ensures you get bang for your buck, maximizing the value of your investment. Now we discuss the second one, debt equity ratio. It shows how much debt a company has compared to its equity. For example, a company with debt equity ratio of 0.5% is less leveraged than one with 2.0, indicating lower financial risk. Higher debt equity ratio can be risky and make the company vulnerable to downturn. Companies with high debt are working on thin ice. The risk of failure is higher. Now we discuss point number 3, return on equity. It measures how efficiently a company uses shareholders' money to generate profit. A company with a return on equity of 20% is more efficient than one with 10%, assuming they operate in the same industry. Higher return on equity is generally a positive sign, but check consistency over time. The proof is in the pudding. A strong ROE shows the company is effective. Now we have discussed the last one, dividend yield. It shows the return you will get from dividend relative to the stock price. For instance, if stock price is 100 and the dividend is 5, the yield is 5%. Great for passive income seeker, but a high yield might indicating financial strain. Money for old rope. Dividends can feel like easy money for long-term investor. Armed with these ratios, you are better equipped to analyze stock. But analysis is only one part of the equation. Let's now discuss some practical tips for first-time investors. Starting your stock investment journey can feel overwhelming, but these tips will guide you towards smart decision. Start small. Begin with a small amount you are comfortable losing to learn the ropes without undue stress. For example, start with 5 to 10,000 and increase gradually. Diversify. Avoid putting all your money into one stock. Spread your investment across different sectors and stock types. For example, invest in a mix of tech, healthcare, and FMCG stocks. Don't put all your egg in one basket. Research is key. Always do your homework, read annual report, follow industry trend, and keep an eye on news related to the companies you are interested in. For example, before investing in IT companies, look at the latest trend in AI and automation. Set realistic expectation. Stock can be volatile in the short term. Invest with a long-term perspective and patience. Rome was not built in a day. Success takes time. Use technology. Leverage app and tools for tracking stock performance and staying updated. For example, use app like Money Control or Giroda for real-time tracking. And that's it for day 2 of our series. I hope this session helped demystify stock investment and gave you the confidence to take the next step. If you found this video helpful, don't forget to like, subscribe to Finance with Manvi Walia and share it with your friends who might find this useful. Join me tomorrow for day 3. Until then, happy investing and stay financially empowered. This is Manvi Walia signing off. See you in the next video.